Welcome to Long-Term Yield. This is the channel for investors who believe the best returns come from owning great companies for 10 years or more. No hype, no day trading, just calm, data-driven analysis of one stock every single week. Let's get into today's deep dive. What if I told you that you could own the biggest software company in human history with a wide moat at a 21% discount to its own 10-year average multiple? Microsoft, ticker symbol MSFT, $3.17 trillion in market cap. Wide moat rating 9 out of 10. Trading at $460.52, up 2.25% today, and up over 7% on the week alone. Microsoft just bounced off a major drawdown driven by one fear, and one fear only: that they are spending way too much money on artificial intelligence infrastructure. Today, we are going to look at every number on the balance sheet, the income statement, and the cash flow statement, and decide whether this is the buy of the decade, or a value trap dressed in a Windows logo. This is long-term yield. One deep dive per week on a stock worth holding for 10 years or more. Calm analysis, real numbers, no hype. Let's get into Microsoft. Microsoft was founded in 1975 by Bill Gates and Paul Allen, back when most people had no idea what a personal computer even was. Today, it is the third largest publicly traded company on planet Earth, headquartered in Redmond, Washington. Microsoft does not really make one product anymore. It makes three: productivity and business processes, that is Microsoft Office, LinkedIn, and Dynamics; intelligent cloud, that is Azure, plus enterprise servers; and more personal computing, that is Windows, Surface, and Xbox. Three giant businesses under one roof. And the scale here is just absurd. 400 million paid Microsoft 365 seats, 1.6 billion active Windows devices on Earth. Azure is the number 2 cloud infrastructure provider globally with about 23% market share. This is not a software company. This is operating infrastructure for the entire global economy. Now think about what that means for switching costs. If your entire company runs on Microsoft 365, Teams, Azure Active Directory, and SharePoint, you are not going to switch to a competitor. The migration would take years, cost millions, and break business operations. This is the strongest moat in big tech. The official wide moat rating from AI Moat Analysis is 9 out of 10. Switching costs alone score a perfect 10. Brand, barriers to entry, network effect, and scale all score 9. There is no other big tech company with a moat this comprehensive. Now, let's get into the financials. This is where things get really interesting. Revenue: $318 billion on a trailing 12-month basis. 10 years ago, Microsoft was doing $96 billion. That is a compound annual growth rate of about 11.7%. Steady, predictable, and accelerating. The most recent 12 months were up 17.9% year over year. Operating income: $149 billion. That is an operating margin of 46.8%. For a company doing $318 billion in revenue. Net income of $125 billion. Net margin of 39.3%. The industry average is 18%. Microsoft is making more than twice the profit per dollar of revenue than its peers. Earnings per share: $16.79 on a trailing basis, up from $5.06 just 6 years ago. That is a 5-year EPS growth rate of nearly 19% annualized. Projected EPS for the next year is $19.43. Wall Street is expecting another 14% jump. Operating cash flow on a trailing basis: $170 billion. Let me say that again. Microsoft generates $170 billion in cash from operations every 12 months. Free cash flow, what is left after capital expenditure, is $73 billion. That is a free cash flow yield of 2.13% at today's price. Microsoft is a literal money fountain. Return on invested capital, 26.7%. Return on equity, 34%. These are the numbers of a company that is making elite returns on every single dollar of capital it deploys. For context, the weighted average cost of capital is 11%. Microsoft is earning a 15% spread above its cost of capital every year on $3 trillion of value. And the balance sheet. Cash on hand, $78 billion. Total debt, $40 billion. That gives Microsoft a net cash position of $38 billion. Debt to EBITDA of 0.54. This is a fortress. Compare that to almost any other large company. Microsoft has beaten analyst earnings estimates in every single one of the last 9 quarters, not most quarters. Every quarter. The most recent earnings, reported in late April, beat EPS estimates by 21 cents and beat revenue estimates by $1.4 billion. The execution at this company is essentially perfect. The dividend, $3.56 per share, paid quarterly. Yield of 0.79%. Forward yield is 0.89. The payout ratio is only 21%. The 10-year dividend per share growth rate is 10.35%. Microsoft just raised the quarterly dividend from 83 cents to 91 cents, a 10% hike. So that is the foundation. Wide moat, elite margins, fortress balance sheet, growing dividend, perfect execution. Now let's talk about why the stock is even available at this discount. The bear case has 3 main points, and you need to take all 3 seriously. Point number 1, and this is the big one, Microsoft is going to spend $146 billion on AI infrastructure this year alone, nearly double the $88 billion they spent the year before. $146 billion. That is more than the entire annual revenue of Coca-Cola. It is a number so big that Bloomberg warned this could lead to Microsoft's worst quarter since 2008 if the AI spending does not pay off fast enough. This fear is exactly why the stock fell 25% in Q1 of 2026. Point number 2. Concentration risk. Microsoft has a $625 billion commercial backlog. 45% of that is tied to a single partner, OpenAI. If OpenAI fumbles, gets sued, gets regulated, or pivots, Microsoft has a big problem. This is not a hypothetical risk. It is real and it is structural. Point number 3, competition. Amazon Web Services still controls 32% of the cloud infrastructure market. Azure has 23%. Google Cloud is growing at over 25% a year and investing aggressively in AI. The cloud wars are not over. They are intensifying. And Microsoft needs to defend its position with relentless capex spending, which loops right back into our first concern. There are also smaller concerns. Gaming is weak. Xbox content and services revenue dropped 5%. Foreign currency headwinds have been a 2 to 3% drag. And the longer Microsoft spends on AI without proportional revenue, the more nervous investors will get. That is the bear case. It is real, it is valid, and it is the only reason this stock is available at a fair multiple right now. So let's flip to the other side, the bull case. And I think this is where the math actually wins. Reason number 1. Azure is growing 39% year over year in constant currency. Microsoft Cloud revenue is now $51.5 billion per quarter. Fabric, Their analytics platform is at a $2 billion annual run rate and growing 60% year over year. The cloud and AI business is not just growing, it is accelerating. Reason number 2. The $625 billion backlog. This number is up 110% year over year. That is revenue that is already contracted, already signed, just waiting to be recognized. 25% of it will hit the income statement in the next 12 months. The rest extends out for years. This is the most predictable software business in history. Reason number 3. AI monetization is actually happening. Microsoft 365 Copilot, the AI assistant baked into Office, saw paid seat ads increase 160% year over year. Consumer cloud revenue grew 29%. Microsoft just announced a 16% price hike on Microsoft 365 tied to AI features. They have pricing power, and they are using it. Reason number 4. The balance sheet gives Microsoft optionality that nobody else has. $95 billion in cash, $40 billion in debt. They can outspend, outweight, and outlast every competitor in the AI race. If AWS or Google has to cut capex, Microsoft can just keep going. And reason number 5. The multiple. Microsoft is trading at a 25.4 PE. The 10-year average is 32. You are buying the highest quality compounder in the world at a meaningful discount to its own history. Now let's quickly look at the competition. Oracle, market cap $586 billion, PE 36.5. Salesforce, market cap $144 billion, PE 20. ServiceNow, market cap $112 billion, PE 65. Microsoft at $3 trillion is bigger than the next 5 competitors combined, and yet it trades at a meaningfully lower multiple than most of them. And against the cloud giants, AWS, Google Cloud, Microsoft has one structural advantage they do not: the integrated ecosystem. AWS does not own the productivity software your enterprise runs on. Google Workspace lags Microsoft 365 in enterprise. Only Microsoft has identity, productivity, collaboration, and cloud infrastructure all under one roof. That is the moat. Time for valuation. Composite intrinsic value comes out to $553 per share. Median price to earnings value puts fair value at $572. Mean price to sales value at $504. All 3 conservative models cluster between $500 and $575. The stock today is $460. That implies between 10 and 25% upside on the multiple alone. Add a roughly 10% annual EPS growth rate and the growing dividend, and you are looking at potential total annualized returns of 13 to 18%. That is from a wide moat, fortress balance sheet, $3 trillion compounder. Now let me show you the chart. Here is Microsoft over the last 6 months, with the 50, 100, and 200-day moving averages overlaid. The stock just bounced from a 52-week low of $356 in April. It is currently sitting at $460.52, and look at this. It just broke above the 200-day moving average at $458. That is a major bullish signal. And on the long-term chart, you can see this has been a textbook accumulation pattern. Every major dip below the 200-day moving average over the past 5 years has been a buying opportunity. The 5-year total return is 134%. The 10-year total return is over 25 times your money. My buy zones, and this is not financial advice, this is just how I personally think about it. The aggressive accumulation zone is $440 to $465. That is right around the 200-day moving average, exactly where we are now. The heavy buy zone is $400 to $420. That is the 50 to 100-day moving average support cluster. If we get a pullback to that level, that is the spot to back up the truck. And the absolute heavy buy zone, the back up the truck twice level, is anything between $356 and $380. That is the 52-week low retest. If Microsoft ever gets back there, it is the buy of the decade. So what is the verdict? Microsoft is the highest quality compounder in big tech, with a wide moat, perfect execution, accelerating cloud and AI growth, a fortress balance sheet, and a growing dividend. The stock is trading at a meaningful discount to its own 10-year valuation history. The bear case is real, but it is a known risk, and it is already priced in. For me, the math is simple. Microsoft can grow revenue at 15% for the next 5 years. Margins will likely expand as AI infrastructure investments mature. Buybacks and dividends will return another 2% annually. Even at a flat multiple, that is 15 to 18% total return per year. From the safest, highest quality compounder in the world. Position sizing matters. Microsoft is a wide moat compounder. This is the kind of stock you can put a meaningful percentage of a long-term portfolio into and sleep at night. But never make any single name more than 10 to 15% of your portfolio, no matter how high the conviction. The market always has the final word. I am long Microsoft. I add on every meaningful pullback. The next earnings report is July 28th. I expect another beat, and likely another raise in the dividend. If you have been waiting for a clean entry on the best business in the world, you have it. Right here, right now. If you found this deep dive useful, please hit that subscribe button. It costs you nothing and helps me make more videos like this. Drop a comment with the next stock you want me to break down. And remember, this is not financial advice. Do your own research and never invest money you cannot afford to hold for 10 years. I'll see you in the next one. That's it for today's deep dive. If you enjoyed this video, please hit that subscribe button. It costs you nothing and tells YouTube to send you the next one. And drop a comment below with the stock you want me to cover next. I read every single comment personally, and I cover one new ticker every week. Remember, this is long-term yield, real numbers, real analysis, on real businesses worth holding for the long haul. I'll see you in the next deep dive.